Welcome back, financial forecasters. We're about to go into the second quarter and earnings are coming, so let's see if they start to justify all these valuations being priced into the market. But first, we're not going over that today. We are going over 3 acquisitions made by 3 companies that I own in my portfolio. As if you read from the title, it's CloudMD, WealthSimple, and Kraken Robotics. So if you're interested in what these companies are buying and what they mean for the company, well, come along with me, stay for the rest of the video, hit that like and subscribe, and let's see what these companies have been buying up. Financial forecaster, let's go. Earnings season's upon us. Let's go. All right, first on the docket today is CloudMD. Now, a lot of people hold CloudMD in their growth portfolios in Canada. They usually hold CloudMD and WealthHealth as 2 of these great telehealth plays. Now, CloudMD has been quiet lately. They were an acquisition monster at the beginning of last year, gobbling up companies, expanding, and that's how they increased their revenue. They were working on organic growth, but they really wanted to snowball by buying these companies. So let's go over the companies and let's go over what CloudMD just bought, which is probably one of their most exciting acquisitions to date. They just bought Oncidium, which is one of Canada's leading health management companies with a loyal client base, over 500 corporate and public sector clients across various industries. Now, guys, this is important. This is a company that has exposure to health space sectors and industries all over Canada, and that's exciting. That's something we want to see from CloudMD. We want their tendrils of healthcare everywhere in Canada, so that is excellent. Next, the transformative acquisition expands CloudMD's national footprint to include 5,500 clients, 8,500 direct healthcare providers, and over 5 million individuals touched. This means their product has reached over 5 million customers in one way or another in Canada. Now, again, this is still a small company, but they have grand ambition. This is a company that is going to transform telehealth across Canada. And again, they're not even close to their 52-week high of, I believe it's around $3.30. They're hovering around $2.20. It's still, in my opinion, an incredible buy at these values. I knew when they were going through their public bot offering, they weren't going to hold at the $260 or the $270 that the last offering was bought at. But it's come down a lot since then, and it's starting to look really attractive, especially now that it's back on the upswing. So the 100 million transaction value, including the full performance-based earnout, so it's pretty much the performance base of this company, which will direct how much that CloudMD will be buying it for. It represents CloudMD's largest acquisition to date. Upfront consideration implies a valuation multiple of 1.8 times the last 12 months sales. Now that's, you know what, in the space of buyouts and acquisitions in Canada and in all of North America, 1.8 times sales, that's a pretty good deal. Like, I'm just throwing that out there if you guys have a different opinion on that, but 1.8 times sales and buying a company that is growing, like I think it's like 30% compound annual growth year over year. We'll get back to that when I go over the numbers, but that seems like a pretty good deal to me. So this is their largest acquisition. This company was on fire earlier last year, and now with this is the biggest buy they've made to put into their portfolio. Guys, that is that's pretty good. I'm just saying. Like, so let's give them props for that, and let's keep an eye on that. Oncidium has a strong financial profile with last 12 months revenues of $37 million. They're buying them for $100 million, and their last 12 months was $38 million in revenue. That seems very good. Adjusted earnings before, that's their EBITDA, which is even better. And their margin of 14% and a 4-month revenue run rate in excess of $40 million annualized. That is a good number. This is a solid business. Good for CloudMD for picking them up. Oncidium has a significant growth projection with a revenue of compound annual growth of more than 30% and a blue chip client base that includes many of Canada's Fortune 500 companies. Now, guys, they bought a company that has exposure to the biggest companies in Canada. They bought a company that has compound annual growth projections of over 30%. That is fantastic. CloudMD has been snapping up some gems, and this one just seems like, well, the rest. It seems like another gem that will add to their bottom line. Good job, CloudMD. The employer market is the fastest growing growing area in healthcare spending and is expected to grow by 130% in 2025. Excellent. So if you're buying CloudMD, you're looking for a company that has growth into the future, it's getting into a new technology, and it's ripe with disruption. This is a great company going forward. CloudMD, here we go. This acquisition accelerates the positioning of CloudMD as the leading service provider in the employer market and creates opportunities for synergies and cross-sales existing services. It's good. It'll keep being good. Excellent. CloudMD will host a webinar today to discuss the acquisition. Now, you know what? I didn't read that last time, and I'm going to go over that webinar. I did my Banksa webinar, and that turned out fantastic. So I'm going to see if I can find this CloudMD webinar for you guys. And if you'd like to see me cover that and give you my thoughts on it, leave a comment down below, and I'll see if I can get to it. So that's it for CloudMD. It's at $2.20 a share. It's far down. It's over 30% down from its all-time highs. Seems like a great time to get in. For me, I have been averaging down very slowly because I already own a large position, and most of my money in the telehealth space is being put into WellHealth, but that's what we're going to get to next. So let's go next, the WellHealth acquisition. Now with WellHealth, they made a purchase that is not exactly as awesome as the CloudMD purchase, in my humble opinion, but it's one that fits in their growth strategy of buying high margin businesses with good revenue already and adding it to the revenue that is in the WellHealth portfolio. Now, and unlike CloudMD, where they're pushing much more into the telehealth, WellHealth is much more a physical client space, and they love buying clinics and doctors who are serving and already have that kind of client base and brick and mortar feel with telehealth integrated within their portfolio. They buy the company, they make it better, they make money off of it, they grow, they buy another company. We've been going over WellHealth a few times now, but again, where it's at, I believe it's at around $7.30, or it could be more. Honestly, I'll put the price right there somewhere, and I will tell you guys, but WellHealth is a company that I see at least hitting, guys, my projection's at least $12, $13 by the end of the year, and that's probably conservative in a lot of people's minds because the price analysts are going anywhere between $12 to $14. I really like this company, and I'll read you some of the stats of this current sale. So, ExecHealth is the company that they're buying. It's a provider of primary care and executive health services in the Ottawa region, and it signifies WELL's first acquisition of clinical assets in the province of Ontario. Now, Ontario, I don't have to tell you this if you're in Canada, is one of the powerhouses of the Canada and is one of the biggest growth markets that there is in telehealth, in healthcare, and it is fantastic that they're buying primary care assets in Ontario. For the 12 months ended February 28th, ExecHealth had unaudited revenues of approximately $3 million, of which greater than 2/3 is considered recurring membership revenue with EBITDA. Remember, that's earnings before interest, taxes, depreciation, and amortization. We'll do a video about EBITDA eventually, but most of the people watching this already knows how important EBITDA is. It's pretty much the profit after everything's taken out and accounted for. It's a very important number, and it always wants to be growing. If you're looking at a company and they have growing EBITDA, it's a good company. They have margins exceeding 50%. Now, this is what I've been trying to tell everyone with WellHealth. You want to buy a company with great margins, and WellHealth is only interested in buying companies that have high margin businesses. This is a company that's going after the companies of quality. They're not going for quantity, they're going for quality. And when it comes to stocks and it comes to a company that's gobbling up as much as they can, if they can continue to find these companies with high margins and make them even higher, it's going to be a cash machine. I'm loving WellHealth strategy. Again, best managed company on the best small cap company managed in all of Canada, in my opinion. So next point. ExecHealth is a high-growth operation that has organically grown both its revenues and EBITDA at growth rates of 20% over the past 3 years. Now, this is some small private company, ExecHealth. To grow your margins 20% organically every year for 3 years, guys, that's what we're looking for. That's a winner in your portfolio. That's a winner in your business. That's something you want to buy out. I can only read you guys the great, like, sounds like it makes sense. And when you're buying into a company and what they're doing makes sense to you and it's just easy to understand, there's a reason why it's easy to understand, because it just sounds like a good deal. It is a good deal. Let's keep going. ExecHealth has 1,000 clients with greater than 2/3 being recurring membership. Recurring is a very, very important word when it comes to healthcare and telehealth in anywhere. Recurring just means the subscription model, and people are coming back and they can keep those clients and they can gain money from it. Netflix is a recurring model, and we all know how well Netflix is doing. So ExecHealth is a primary care asset. Fits right into WellHealth's growth strategy. It's a very good acquisition. It's a great pickup, and I'm very happy with it. I have a very large position in WellHealth, and for anybody out there who's wondering if you should be buying WellHealth at these prices, yes, it is a 10, 20-year, 30-year rule. This will be one of the largest healthcare conglomerate companies in Canada within 20 years, in my opinion. I really think it's a very smart pickup. And the last company right after WellHealth, and I know this is for those nerds out there who are loving this company and are just waiting for it to explode, we have Kraken Robotics. So let's get to that next. So last company, Kraken Robotics, PNG on the TSX Venture Exchange, a penny stock, a stock that deals with robots, undersea development, battery technology, and is one of the coolest companies on the Canadian market right now. So what has been happening with Kraken? Nothing really. We've all been waiting patiently. It broke that 50-cent range and has got into the 70-cent range, and it has stalled out again. And we've been waiting. And a week ago, we got their final base shelf prospectus came out, and everyone's like, what's a base shelf prospectus? It's pretty much, they just wanted to start the paperwork to sell shares to raise money, because they knew they wanted to buy something, but they didn't know quite yet what they wanted to buy. So they got all the paperwork, they got everything ready, and everyone got a little bit nervous. Like, what are they doing? Are they just raising capital for no reason? Are they in trouble? Well, as of this week, we know what they were doing. Kraken Robotics, they're looking to buy a company, and they have entered into a letter of intent to acquire Subsea Services Company. Now, I was like, what's Subsea Services Company? I had no idea what it is either. So I had to look it up too, and we're gonna learn about what it is together. I'm just gonna read it off here, because if you don't know and you're watching this video and you wanna know what it is, let's read it together. Kraken Robotics, Canada's ocean company, is pleased to announce it has entered into a non-binding letter of intent. So you gotta be a little careful with these non-binding letter of intents, because that means based on multiple reasons this deal could fall through, and it is a little bit of cause of concern. Do not load the boat with Kraken assuming that this company buy is going to go through. It's based on a lot of different factors, between going through and auditing their performance and going in and seeing the numbers. So it's not binding yet, but it shows that they have put in an offer and they're going to explore the sale. What's Pangeo Subsea? I've never heard of it. You've never heard of it. It is a private Canadian services company specializing in high resolution 3D acoustic imaging solutions for sub-seabed. Now, if you don't know what Kraken is, they make robots, they've got cool batteries, they're autonomous, and they travel the seabed. High imaging, they help with oil discovery, preservation, military applications. They're a very cool company, as in they're making robots. They're selling them to the military, they're selling them to gas giants, they're selling them to anybody who has a need to explore the seabed and take high image resolution pics. This is a crazy stock. No one knows the future of it. Who's showing interest? We know that military is, and we know their next quarter is going to start reflecting some of those bids, so that's fantastic. Their last quarter, not so good, so we don't know yet. There's not much known about this deal, so I can't really give you too much information on it. All I know is they will be selling more shares into the open market to raise money to buy this for this acquisition. So that's it really for Kraken Robotics. Is it a buy at 70 cents? I'm holding my shares. If you want to play a little bit risky, yeah, Kraken is definitely the riskiest of the three we've talked about today. That's it for Kraken Robotics. So let's just do a recap of the final three companies. So today's update, nothing big. I just wanted to talk about those three companies that were going forward. CloudMD seems like a buy, WellHealth seems like a buy, and Kraken, I don't want to endorse it as a buy because it could be a little speculative going forward. And if you're making a growth portfolio, there is a ton of different stocks that you should be putting money into. other than Kraken. I'm going to hold my shares. I definitely want to see about this company. I'm definitely excited about the quarterlies, but CloudMD and WellHealth are solid growth picks for your portfolio. I'm going to definitely be increasing my positions as I go forward. I'm loving what they're doing. And that's it for the weekend. So this week though, earnings are coming out from all the big American banks. It is it's an important time for the market. I'm just telling you this, all of this new growth has been priced in, the recovery of the economy, and we are looking forward to together to see if any of these prices are any of these earnings are going to justify moving forward how they're priced into the stock market right now. If even there is a little bit of weakness, please have some cash on the side to start averaging down, because there will be some drops if some of these quarters do not hold up to investors' expectations. That's the financial forecaster today. I'm glad we're getting rich together. I'm glad the channel has been growing so much. I'm loving everybody, their comments and their messages to me. Thank you so much. Hit the like and subscribe, please. It's helping out the channel greatly. I'm super thankful to everybody, and I hope you have a great weekend. That's the financial forecaster out. Have a great day.